Oh, right. We are live. That's Jeff Macke. Spencer Israel. This is Jeff Macke live. Jeff, we are approaching the end of the year, the end of the retail earnings season. So I thought we should look back. Let's look at the last few weeks. We have some earnings season winners, earnings season losers, and a couple stocks that are like TBD. We don't really
Yeah,
know.
we laughed, we cried, we learned a lot. At the end we all hugged. You sound horrible, by the way, and I mean honestly, I'm catching some virus just through the internet. So yeah, but we you always have winners and losers. But remember,
Yeah.
a month ago, no one believed. Who believed? No one. And I assured you that was how things were going to work out. Was that at the end of the movie, Santa was going to come. Mall stocks are just as a blanket, they are just crushing, absolutely crushing, just giving up for dead. They are the winningest winners out of our earnings season. They reported and truly incredible. This is a basket of 10 mall stocks made and provided to members years ago or last year. But they're up 26% versus the S&P, basically flat. That's just since November 26th. That's the Monday before Thanksgiving. Wow. So if you would have done with the all-time stupid trade, I think people are going to be shopping, and maybe that'll be good for some of those stocks. You made your year. Your year is done. That's the one trade you had to do, was just make that dumb guy voice and just put 150% long in like Victoria's Secrets, Abercrombie. I've got kind of just a basket of Meshuggah mall stocks, and they're crushing it. As you can see, Santa's jacked. He's never been more ready in 2,000 years of being Santa. He's fit and he's buff and he's all that. So that's the first one.
A great point. Sometimes the stupidest trade is the best trade, right?
The most obvious. I mean, I was a little embarrassed about it kind of all along, just because, well, and we have to include the dollar stocks, which weren't necessarily a stupid trade, but they're just, it's the economy's getting weaker. The dollar stocks win. There's a huge flaw in that thinking, in that when the economy's genuinely weak, nobody goes shopping, especially the economically downtrodden. So just right on the surface, that as an idea is demonstrably kind of stupid. Yet, if you would have said the economy's screwed, I'm going to buy dollar stocks, you are making bank this year. It's a trade I was in Dollar Tree, Dollar General. If you just would have said, I'm going to buy the dollar, and you didn't know how to do that in a currency way, so you just bought stocks named dollar, you actually won.
I don't think that's how
I don't think it does, but you know what? It's good luck telling that to someone who's up 80% on their basket of Dollar Tree and Dollar General this year. Both chains got a little better, kind of surprisingly different companies, if you get right down to it. And truthfully, what they did was they cleaned up their stores quite a bit. Both of these chains, they fixed the Family Dollar problem, and they're just doing well. They're stocks that are right. They have great adjacencies, great locations, close to everybody. One of the huge themes this year was actually just kind of convenience, the morphing of online and offline. But the other form of that, the terrestrial form of that, is just, it's nice to go to a store on the corner, all things being equal, what the prices are good. And so big win for the Dollar Tree and Dollar General type of year. Of course, the denim trade. And of course, it comes with graphics. AEO, Victoria's Secret, they won over big, enormous comebacks since this summer for both these companies. They were really kind of both tariff-ridden and not spectacularly well-run companies. Lights out quarters, and hilariously dismissive of the entire Gen Z doesn't shop idea. So the real trade this year was fading every single headline you saw that just made blanket assertions about people in their 20s, which just, I've been in the media before as a general truth. Whenever someone says, Gen Z hates Smurfs, it's just kind of someone looking for a headline and sell. So, it's clickbait type of stuff. But the idea that it's both of these companies that's worked to the effect of Gen Z is absolutely not a problem for us. They're lining up outside the doors. Enormous quarters, and as of their conference calls, the business continues to be great into December. Now that's not going to stop. Eventually, it'll be a sell the news experience, but not anytime real soon. So it's the mall in general wins. These two in particular are huge. We can get to the losers. We can get to it's. You just guide me, you sick one.
Yeah. No. I want to stay here for a second. So bottom line here, if we're talking about like this past earnings season, but also just the year writ large, big winners, the mall, denim, and dollar stores. Right.
Yeah, and it covers the entire year, but it really covers the last quarter as well. I mean, it's they took the steel-toed boots to the last of the doubters. People kept saying, "Oh, the Sydney Sweeney thing's a fad." It wasn't. The Gen Z never shops. They stuffed it right in their face. And so the way earnings season falls with retailers, it happens to kind of coincide with that cyber week type of thing. And Americans went out and spent $700 billion, $770 billion. Forgive me. It's going to be $1 trillion year. We got a lot of stuff going on, but that doesn't mean everyone won. And every life a little rainbows fall.
It wasn't all sunshine and roses for everybody this earnings season. What's the deal with this chart? Costco and Amazon?
Costco and Amazon have had kind of lost years, and for slightly different reasons. They're both pretty much tariff proof. They don't really have a problem. Amazon, they've got, maybe they're serving too many masters with everything they have going on in terms of, it's a tech company, it's a retail company, but their numbers are terrific. The stock can't get out of its own way. And every time it does go up 2 cents, Jeff Bezos and his ex-wife just stand in line. The only thing they can get along on is the idea that it's time to sell another $2 billion worth of shares of Amazon every time it goes up a penny. So they've been stopped. Cost is more of a mystery. Cost is now 20% off its all-time highs. It's bad news. If you go down to 10 there, cost is like this is a real decline. This is kind of a real thing. You and I are both long. It's expensive on a multiple basis, but the business model hasn't changed. Memberships are tremendously strong. Same sort of sales haven't been that great, but it's almost like in Consumerville, the dispersion among companies is so great that it's, every dollar spent one place comes at the expense of someone else. I don't think cost is doing anything particularly wrong. It's just a wildly out of favor stock. And with multiples that high, it's hard to get excited about 3% comps, which is the problem that retail runs into. But 20% off, that's a 10-year chart of pullbacks from cost all-time highs. You can see that it's been since 2022, which was not it was an actual genuine catastrophic year for a lot of retail stocks. It hasn't been this far off the highs in quite a while. And that chart looks weak. It looks like it's just kind of rolling over. We're hoping that it builds a base sometime soon, but to build a base, you got to stop going down every day.
Jeff, sometimes the stocks are just in favor or out of favor, and that's just the way it is, right? You gotta,
I suppose it is. It's sunrise, sunset, and all that. And Children's Place this morning, absolutely.
I was stunned. I didn't know this company was still around, honestly.
You didn't know, and neither did a bunch of shoppers. Apparently, this was $111 stock 4 years ago. 4 years ago today, $111 bought you one share of Children's Place, which you could turn around and sell for $4.69 today. They didn't just kind of miss. It's you throw the baby out with the bathwater. You can see I've got a plunging baby. Don't show your kid that. Your child is too young to see such graphic images. And I hated to draw the little picture, but this was a terrible conference call, and these guys are fading into Bolivia, as Mr. Mike Tyson once said. Down 39% today. It's now just $100 million stock. They were going to take over the world not very long ago. They were considered a threat to Target's kids business, which has traditionally been a strong point for them. It's like you say, sunrise, sunset. Most retailers kind of end up at zero, and these guys are going there about as fast as they can.
What would worry me about this stock is,
everything.
At least from the short side. No, from the short side, is it's got a very small float and a nice high short percent of float. So,
there is no
interest, low float. This is it could be squeezy. It's not squeezing today.
But this is a runaway. People were betting on Squeezy today. That happened to the folks that were betting on Squeeze with iRobot as well. Stay well clear of these things. I've dug into the papers on Children's Place a couple of years ago. It's been a while, just because it's a grim story. It's a very strange ownership structure, not really to be trusted. And I mean, again, they earned $2 this quarter last year, and they lost 18 cents. It's not the kind of company. I mean, that's a multiple compression story. So it's a little icky.
All right.
It's a little icky.
All right. What about the question marks? These are companies that either had good reports, bad reactions, bad reports, good reactions. We're not quite sure what to make of it.
Yeah, if they made the game too easy, everyone would win at it. Lululemon reported an absolute just steaming pile of garbage quarter. We talked about it. It's Sean and I put on a bullish trade on it in the options portion of our little program. It worked out pretty well. The just the idea that you kind of get washed out. Now they've taken down earnings. They did like a little sleight of hands where they beat in the third quarter supposedly, but then they took down their full year estimates lower, which is the tantamount to warning like crazy. America still has negative same store comps. Nothing good's happened there, but they also made the CEO walk the plank. And
that's good. That's good, isn't it?
It's pretty good. I mean, it's the people that used to run Lululemon think it's good, and I don't suspect they're wrong. You certainly need to change something, and as they say in baseball, it's easier to fire the manager than the whole team. But the stores are really tired, really in need of a swift kick in the ass. Now, going into the quarter, it's the idea of the trade on the long side was that they said the last time they warned, and by the way, they suddenly are a company that warns every quarter now. It's about 5 in a row. They said they don't expect new merchandise in until spring of 2026. So that raises some question like, what's the new CEO supposed to do about the new crap that's coming in? Because the stuff they have now isn't that great. They've got mules for men. Are you familiar with mules? Just kind of ugly, like nurse type shoes.
No.
They sell them for men at Lulu for $180. The new guy's going to have to do better than that. Like that would be an example of them needing a strategic spritzing, a little freshen up. But the stock's relatively cheap. And if it gets this easy, they're washed out. I could have put Abercrombie up as well. But this was probably the worst report, best reaction, just in terms of it was another quarter of real disappointment there at Lulu. But it's the Wall Street celebrated the firing of the CEO. Now, the flip side of that are companies that report good news and get no love for it whatsoever, which is our next slide. The Williams Sonoma factor. I've probably mentioned it before. I have a little bit of a crush on the CEO.
Yeah,
just a very talented person. What are you going to do? But honestly, what are you going to do? It just is what it is. Smart and talented. I go for that. They beat 5 quarters in a row. They're absolute machine. Absolute machine. You can see the reaction. I wrote it there. It went up to 190, which was probably the reaction that everyone thought it deserved. Yay, Williams Sonoma finally rallies. Went down 20 points in about a nanosecond and closed at 174 the day they reported a 12% range. The numbers never changed. They didn't get on the call and say, "Oh, we were just kidding. We changed our EPS." But this company is they've beaten 5 quarters in a row. It's up 1.6% or something year to date. It's been a really tough year. It's a bleak Dickensian type of Christmas outlook for people that have been trying to invest in Williams Sonoma and just stay long. Someday the stock's going to rally. It's not going to be this day. Again, best results. I've got nothing bad to say about the company. Biased or not, it's. I don't have blinders on. I mean, it's even if Laura missed, I would point it out, and she hasn't. It's been a terrific company. Just a really hard long year. Restoration Hardware had kind of a decent quarter. Stock popped a little bit, so maybe Williams Sonoma is just waiting to be sold out more. But the company is becoming cheaper. I keep it on the radar. Not for personal affection reasons, but because companies that earn a lot and the stock doesn't go anywhere, they get cheaper. And that's how you get a nice coiled spring. That's what a base is. When people say it's technically forming a base, what companies are generally doing is getting cheaper because the stock's not moving higher as they earn more. And that brings us
bottom line. Wait and see,
yeah. Which is where we are for Nike. Now this we've got a Lulu setup. Going into Nike, this is a 5-year chart. This has been not good. No bueno. It's Nike, as far as I know, still on their investor relations page, proclaims in large font that Nike is a growth company. Now you can call them Nike. You can call them Nike. What you can't call them is a growth company because they don't grow anymore. And this is going to be another quarter where we're 2 or 3 in. Where you're kind of expecting to see some traction from the new CEO. I don't think they've got the horses. People really want to believe in this company. It's a super easy pitch. If you're a broker, if you're trying to get some highfalutin client to, you want to buy stuff when no one believes in it, you can probably sell them 500 shares of Nike. If that still happened in Wall Street, I don't think anyone makes commission enough to make those phone calls anymore. But it's, if you look at Dick's, if you look at like Foot Locker, if you look at places that actually sell Nike, they're having a lot of problems on the high end. They still have markdowns, and their clothing division is just a train wreck. I don't know that any of that changes tonight. And still, if you put a gun to my head and said, you got to bet on the outcome of this stock, I would say they're going to miss by 900 miles and the stock goes up 5%.
Yeah, I recall you saying last quarter that it was probably going to take another, I think you said like 6 to 9 months to really see if this leadership team has it or not.
Yep. And I stand behind that, just because there's a big product lag. Someday they're going to make Caitlin Clark shoes and sell them to these 1,000,005 approximate young ladies who actually play sports. It's an enormous market. Nike used to own it just without a doubt, that just everyone wore Nikes. They don't anymore. So they're going to have to win that customer back for starters. And so it's going to take a while. They've got to make friends with the retailers. But that's really kind of that last one I mentioned is the big rub. Nike, they stopped selling through a lot of vendors because they thought it diminished the quality of their product and the perceived quality. It turned out that was not the case, that the quality, the voters, the consumers are the voters of quality, and they voted that they don't like Nike shoes anymore. So it was a real problem. Now they're back on the shelves. If you walk into a Dick's, you see a lot of Nikes marked down. That's a red flag. That's what we call that in the industry. If you see people buying Ons for $250 and kind of walking past similar running shoes made by Nike for $150, it's a problem. And so, in a situation where the new CEO is all about, we got to win over the vendors, we've got to win over the retailers again, it's hard to win them over when you're making them mark down your product. So we'll see. It's going to take a few quarters before anything tangible happens. That said, what these guys still do well is market themselves. I mean, if you claim to basically have invented sport, which is kind of what most of their marketing does, you're able to sling a little BS with the best of them. This is going to be just a story quarter. I would really not expect to be seeing good numbers here when they report, but you could get some reaction. It's Glory's last chance. If you were gonna bill it, this is your last shot. If you happen to run money professionally, you're running out of time. If you're losing to the tape, it's time to start chucking up some threes. You might as well wear Nikes to do it.
I can't see it on my platform now, but I was trying to look up what the expected move is tonight. Wait.
Oh, it's Thursday.
Tomorrow. Yeah, tomorrow.
Yeah. I think it's like 9%. It's fairly high.
9%. That's higher than I would have thought, honestly.
Yeah, they've ripped off a few faces over the past few quarters. So again, but it's another story where I'm not sure how much bad news is built into it. No one thinks anything good is going to happen, and that was the case for Lulu. Now that said, they don't have a CEO they can make walk the plank there. They just hired the guy, so. I think we probably have a pretty stable bottom technically at about 60. I don't think it goes much lower than that, just because there's not going to be anything particularly newsworthy. The shoe industry is pretty insular and it's pretty clingy. And so everyone kind of knows what's happening in shoes before the companies come out and announce it. And right now what's happening is that Hoka's are doing okay. Ons are doing terrific, just defying all kinds of logic. And Nike is not seen as the hot brand that it was anymore. And that's a problem because they're a $50 billion company. So you got to sell a lot of shoes.
Did you ever see that Air movie?
I did.
Yeah, it was good. I liked it.
The one with Affleck or the one with
Matt Damon? It was good.
Yeah. That was pretty good. And then Pre. Have you seen Pre? Or were you too young to see Pre?
I don't know what that is.
God, it's so sad. You need to crawl into bed. You need to watch some classic movies. What are you looking for?
I was going to say, this is my favorite business book that I've ever read.
That's probably the best business book that honestly, I gave that to my son to read just because I wanted him to like business. It's a tremendous business book. Phil Knight is candid. He's honest. He's great in it. He went to Stanford Business School, which by definition means he's brilliant. It's a good book. It's a good book, and he tells fun stories. Yeah.
All right, let's get out of here. Thank you for watching. If you're watching us on YouTube, do us a quick favor. Hit the like. I'd appreciate that. Jeff, we'll see you, I guess, next week, right? I guess we'll
maybe next week. I don't know. There's a holiday coming up. I'm not sure what it is.
We'll figure it out.
Get out there and shop, people, or the Chinese win. Damn it.
That's right. All right. Thank you, guys. Adios.